Hello, everyone. This is Joseph Trevisani. I would like from Worldwide Markets. We are located in Woodcliff Lake, New Jersey, not far from the firm that you probably know we more familiarly with. That would be, of course, FX Solutions. Just a brief bit about us. We do the same type of business that many other FCMs do. We are registered in the Netherlands and soon to be registered in Britain. We're also registered in BVI. We do currencies, commodities, indices, metals, oil. So if you're interested in trading, please have a look at our product. Now, what we're going to talk about today, and I'm going to do it by comparing various commodities, has been the effect of the Fed FOMC, last FOMC 13th of September last month, a little more than just about a month ago. Hold on one second, I'm just making sure this works, apologize. I want to choose which ones will be the most interesting things to compare. Let's look at WTI. Okay, so first off, we're going to talk about, okay, here are two commodities you're all familiar with. Not really commodities, but trading items. So a little background. Let's look at the euro first and talk about some of the things that were leading up to our current state. Since the financial crisis of last year, trying to take off some age here, of 2008, the markets have been trading, all the markets back and forth on central bank fundamentals. And by fundamentals, I really don't mean much in interest rates anymore because we've moved well beyond that. They're trading on what central bank actions will be, primarily the amount of liquidity being provided, and the amount of, you might call it, existential fear in the markets for all sorts of things. But the basic one would be the collapse of the world economy. This is not going to happen, of course, but it could. And that makes people defensive in their choices. So as that approaches, meaning the world economy starts, or any particular country, starts to look much weaker, that reaction flows into the markets. We have the safe haven effect. We have all of this effect is spread out differently through all different trading commodities, trading markets. The commodities, the ones I'm going to look at today particularly are the commodities, oil as an example, currencies, which have a tendency to all trade the same on this, and treasuries. I have two dates on these charts. 726 was the famous whatever it takes quote from Mario Draghi. 913, as I mentioned, was the FOMC. It's obvious from these charts. The top one is the euro, and the bottom one is WTI. That's West Texas Intermediate. That is I think it's the largest volume traded oil type. There are lots of different oil types and lots of different oil settlements. You know, when you listen to the market, you tend to think, oh, they're trading oil. There are lots of different oils. The two ones that everyone is familiar with are Brent, which is traded, was traded on all exchanges, but comes from the North Sea, and West Texas Intermediate, which doesn't necessarily come from the United States, but is priced through the center in Cushing, Oklahoma, I believe. The difference in the prices, there's generally been about a 20% premium for Brent, it has to do with the distribution variables and some of the restrictions and constrictions around getting oil in and out of the Cushing terminal, because that's where people actually take delivery. So you can see from these charts, more so in the euro, of course, as you would expect, and we'll look at some of the other currencies. They all essentially mirror this. The big move, the big change, the big item, the big central bank notion was the European Central Bank's promise to defend the euro. That is the reversal in all the currencies. Whichever currency you look at, let's take a look at some of the others. Now, the yen has a less dramatic move, and there's a very good reason for that, and I'll show you exactly what it is. And, of course, it's the euro-yen. The yen has essentially since the financial crisis had no independent trading life. I exaggerate a little bit, but not a great deal. The euro-yen and the euro move, and the yen just sort of sits there. Again, take a look at these charts. I actually put up a brief note about this a couple of days ago. Take a look at the yen. We've gone from here down to here and back. We haven't moved anywhere. If you look at it, look at this level, 78.28, and that's just about where we were 2 months ago. A little more, 2.5 months ago. That's what happened in the yen, but look what's happened in the euro. The euro's gone from here to here. The euro-yen has gone from here to here. So whenever you're trading the euro or the euro-yen, you're trading essentially the same currency. In the yen, you're not trading at all. Kind of an interesting change in the makeup of how currencies trade. A lot of reasons for that, but we're not going to talk about that today. It's an interesting subject, though. Okay, so let's bring up where's WTI? Let me bring WTI back. I apologize. This is the first time I've used this software, and not exactly rusty on it, but it is a little bit of a new endeavor, so it takes time. Okay, so naturally enough, the two responses, we're talking about two responses here on these two dates, but since they are both responses outside of the normal realm of trading markets. Normally, oil will trade on supply and demand, normally. Currencies will trade on economic statistics and their effect on interest rates. That's the old paradigm. In currencies, certainly, that paradigm is long gone. We're now trading on not through the derivation to interest rates, but on what the central banks are going to do, especially the Fed, as far as flooding the world with liquidity. So we have the two sort of parallel fundamental aspects of the market these days. Is there going to be any economic or disaster, financial disaster, if you will? What's going on in the ECB is perfectly, in Europe, is perfectly indicative of that. You know, I want to, let me pull up the chat here. Yes, thank you. I forgot to mention that. I'm a little out of practice with webinars. If anyone has any questions at any point on any topic along the way, I much prefer audience input. I don't care what the topic is. Don't ask me about Martha Rothko or Picasso, but almost any other topic I will be glad to talk about, if you'll be glad to listen. So please contribute if you have any questions that you'd like to bring up, and I'll be glad to discuss them. I think we get a much better webinar, and it's much more interesting if we do that. I also end up learning a great deal from the people in the webinar, which is something I always like as well. So again, just pop into the chat and type in any questions you have. Okay, since I asked for it, I guess I have to answer. What was the Minoan currency? I'm not sure that it had a name. And I'm not even sure the Minoans actually coined currency. Because if I remember, the first coin is from Greece. I mean, the first coin that we would call a coin was from Greece, probably around 800 BC, I think. That doesn't mean that other items were not used as currency. Absolutely they were. So whoever knows if the Minoans had an actual coined currency, please answer. The Minoans certainly had record keeping and a language and a script, I think one of which has not been deciphered yet, if I remember correctly. Yes, and there were great in 1500 BC when the Minoans were in flower in Crete. There were trading routes throughout the Eastern Mediterranean. There's a very good book on that by a woman named Jacquetta Hawkes, and it's called Dawn of the Gods, and I happen to remember it because I was looking at it during my dinner about 2 nights ago. I have it at home. So if you're interested in Minoan and Mycenaean civilizations, and they are fascinating, they're certainly the precursors to the classical Greeks in all sense. Take a look at that book. It's The Dawn of the Gods, Jacquetta Hawkes. Okay, so back to our issues. For the currencies, and let's bring up another currency. Let's bring up Euro Yen. Actually, let's bring up cable, because cable's a better example of this. Paul Volcker, I recognize you. Welcome back. Let's bring up sterling. Okay. So now we're going to look at the sterling and the euro, and you'll see that their reactions to the ECB promise were almost identical. And that's because here is, let me make this one a little bit bigger. As I said, I thank you for your patience with this. It's my first time with this new software, and so I'm not quite as rapidly skilled as I would hope to be. Okay, here we go. So this is the ECB announcement. Mr. Draghi on his white horse, or maybe his white Maserati. They're probably well paid over there. Announcing that he will rescue the euro. Now, we've noticed, of course, that nothing's actually been done. Later on, about a month later, a little bit more than a month later, actually about September 9th or September 6th, I believe, is when they actually came out with the proposal for the unlimited bond purchases. Well, it's still a proposal, and it's not going to be enacted. It looks like the Spanish are very reluctant to give up any financial sovereignty. There's no surprise there. I'm not going to comment on European culture as much as I would like to, but the Spanish have no country would like to give up that kind of sovereignty. And so the Spanish are very reluctant to do it. And if Prime Minister Rajoy can possibly get away with not asking for a bailout, he won't. However, the bailout and the need for it is not going to be determined by the state of the Spanish economy. Not directly, anyway. It will be determined by whether or not the credit markets drive Spanish rates to unsustainable levels again. That's what's determination here, and Mr. Rajoy has said as much. He said if the rates stay too high for too long, we will have to ask for a bailout. Now, they may have to ask for a bailout anyway, but that is his sign. Now, rates have come back down. They were at one point in July, I think July 24th, about 7.6% on the 10-year, the generic 10-year for the Spanish. That's way more than they can afford for any sustained amount of time. They're now back, I just looked before I came in here, about 5.8. Also difficult, but I suppose not impossible. The idea that there is some level of sovereign rates that are impossible for countries to sustain is nonsense, or any specific level. If rates stay at 5.8% for long enough, that would become unsustainable for the Spanish economy as well, depending on the condition of the economy. This is the opposite problem of the opposite condition of the United States. That's another topic, one of my favorites, but not right now. So even though nothing substantially has changed. In fact, the Spanish economy is probably in a little bit worse condition than it was. The fact that the ECB has not intervened in Spanish rates. The promise that it will do so, if necessary, has been enough to provide this boost to the euro, because the reason the euro was down here, of course, was because of the concern, perhaps the impending dissolution of the Eurozone. Now, the Europeans have said from the very beginning, and all of them in a position of power, Angela Merkel, Sarkozy, Hollande now, all of them, that the euro must be preserved. It sounds like Cato in the old Roman Republic saying, what did he used to end every speech with? Carthago delenda est. It's one of the few things in Latin I know, but it means Carthage must be destroyed. That was during the Punic Wars between Rome and Carthage. Now, all of the European leaders are saying exactly the same thing. The euro must be preserved. We can go into the reasons for that. Yes, Hannibal was the general on the Carthaginian side. I don't know that any of Hannibal's speeches have survived, although Cicero's have. The conquerors always write, the winners in the wars always write the history. So despite the fact that the Europeans have not had to do anything, the urges of the markets have been very diminished, have been thwarted by the threat that they will. So if, in fact, the credit markets, and this still could happen, if the Spanish economy goes into free fall, and it could, because the world economic situation is looking particularly polarized right now, particularly difficult. If things get worse, then yes, the credit markets will sell off Spanish debt, the rates will rise. But they know that there is limited, because the credit markets know, the participants in the markets, after all, they're traders. They're looking to make a profit, or at least to cut their losses. So they know that if the rates go back up, and they're caught in the game of musical chairs when the ECB intervenes, then they're going to get killed. So the promise of the ECB that they will intervene has been effective to control the markets to some degree. The same thing has happened in the euro that happened. I didn't bring Spanish bond rates in. I actually should have, but I forgot to do that. But you can imagine what they are. The rates are, the prices look just like this, because the price and the rates are inverted in the bond markets. The price goes up and the rates go down. I don't have Bloomberg on this. These graphs, by the way, are all from Bloomberg. The mayor of where I live, New York City, a well-deserved billionaire because the system's great. So the ECB's sheer promise has been enough to turn around the rampant speculation about the decline of the euro, perhaps the dissolution of the euro, and it had exactly the same effect on the pound for the same reason. Because if the euro is going to dissolve, or at least enter into partition, I think probably Europe has had a lot of very unpleasant experience with partition. Both the continent and some countries were partitioned for 50 years. Yes, that's a very good point from Paul, and I'll mention it in 1 second. So what the ECB did had exactly the same effect on the cable, and the reason is because if the Eurozone dissolves, or at least has serious existential problems, no one really knows what the effect on the markets will be, but I can guarantee you it won't be good. Markets don't like uncertainty, especially when they dislike uncertainty. It is very likely to be unpleasant. Therefore, when you remove that, as the ECB essentially has, now, the interesting thing about this is the economic situation hasn't changed. The background economic situation. In fact, you could say it's probably getting worse. But the threat, the existential threat to the euro, was probably removed. It's like this whole thing that's going on with Greece, this whole show. It's essentially a charade of the Troika and everybody down there and Angela Merkel. The Greeks are going to get the money. They've always been going to get the money no matter what they do or what they say, because without it, they leave the euro. There's no choice. This has been true from the very beginning. I remember I wrote a column 3 years ago saying that the Greek position vis-a-vis the Europeans and needing a bailout is far stronger than anyone is giving them credit for. Not because they're good negotiators, because the facts are on their side. If they don't get the money, the euro dissolves. Or at least Greeks leave it. They won't have any choice. So Greece was always going to get the money. What has Greece done? They pass austerity budgets, and then they don't follow them. They were supposed to in the first. I'm not passing judgment here. I'm just making a sort of a factual rendition here. They passed austerity budgets after the first bailout. They were supposed to privatize a whole bunch of industries. Almost nothing's been done. They were supposed to cut lots of employees from the state payrolls. Nothing was done. The same thing's going to happen now. Greece will pass the austerity budgets, and the government will not perform what it said it would do. But it won't matter. Greece will get the money. So this move here is really all that has been necessary so far. Now, okay, let me just look at that question here. You know, I remember when as this has been going on for the past 2 years, and you see a lot of arguments saying, oh, the problems for Greece are that they can't devalue their currency. It's debatable. The problem with Greece is twofold. They can devalue their currency. Look at the euro on this scale right here. It's gone from over 1.4, went down to 1.2. That looks like a devaluation to me, and it's all because of the European debt crisis. The problem for Greece is that most of its trade is with the Eurozone. Therefore, devaluation doesn't do it any good. For the small portion of a trade that is outside the Eurozone, yes. The euro devaluation, and that's what it is, has benefited its economy. But you know who it's really benefited, of course, are the Germans. Because Germany exports products as a huge portion of its economy. The euro's lower. I just bought a Volkswagen, a used one this time. It costs no more than the Volkswagen I bought 5 years ago. Part of that is due to the devaluation of the euro. I remember in the summer before the financial crash, the euro was above 1.6. Remember that? When Trichet actually hiked rates a quarter point, I think in that July in 2008. And then, of course, we had all the fun and games in the fall. So that is a huge devaluation. And it has benefited the export economies in Europe. Germany, until I believe last year, was by value of exports the most valuable export country. Its exports were more valuable over a year than any other country on the planet. It was just passed in total valuation of exports by China, I believe earlier this year or late last year. I'd have to check. So it's now number 2. The U.S. is not a large exporter by this measure. Germany has 80 million people, I think. China's got 1.2 billion. It's an astonishing fact. Astonishing. So, the idea that Greece can't benefit from a lower euro is true, but it's not the complete argument. The real reason it can't benefit from a lower euro is because most of its trade is with the euro. And yes, you're right, Paul, that an argument that the lower, a devaluing euro does help export economies. The problem is that for most of the peripherals, certainly for Portugal and Greece, they're not large export economies. It's a very small portion of their. When was the last time you bought a manufactured product made in either country? That's not true, of course, of Italy. That's not true of France. And it's not true, obviously, of Germany. That's an interesting argument, Mr. James. I will, and everyone can see that, but I'll deal with it in a minute. Okay, so we do have a topic here. I'm going to try, and I know I'm not very good at keeping on topics, but I do enjoy all of these things, and I tend to get sidetracked. Of course, I ask for the sidetracking because I like you all to participate. Okay, so in the euro now, we can see the effect on the currencies of what the ECB did. Okay, let's look at some of the commodities and see. Now, this is, of course, a webinar on intermarket analysis, which really just means you look at more than one trading item, which I have always done, and I think it's the only fun and interesting way to go about this. Okay, so let's take a look and see what we got here. What are we looking? This is WTI. Where's gold? Okay, here we have gold. I have the dates marked on these two charts as well. Yes, Mr. James, you're absolutely correct. The euro and the entire EU apparatus was constructed to tie, and they said specifically, to tie Germany's interests to the interests of Europe. If you're looking for probably the worst century, I would say in the past 1,500 years, that would be since the fall of Rome, it's clearly the 20th century. There may have been more technological advances in that century than in all those centuries put together, and I think that's probably true, including this one. However, in the costs, we had the First World War, we had the Second World War, and we had the Civil War in China. And then we had all of Mao's famines, and we had Stalin's famines, and on and on and on. So if you're looking for a more dismal century, I don't think you could go any further, or would have to go any further than the last century, in which most of us were born. I'm sure all of us here were born. And that is the absolute reason for the existence of the common market, the euro, right down the line. Doesn't mean it will work, but it is an understandable response and a responsible response to the horrors of the 20th century. Okay. Look at these two charts. The reaction is quite different. Now, keep in mind the unvaried reaction we saw in the currencies. For the European currencies, and now we talked about why the yen is not there, and I did not bring up the Aussie because I'm trying to make a specific point with the ECB. The Aussie would have a very different effect. But on the cable and the sterling, and of course their counterpart in both of those pairs is the dollar, the ECB decision or announcement had a profound effect. It removed the currency market's reaction to a dissolution of the euro. And that's sort of what you see here. Sort of. The gold price looks very much like the currency charts. which is a bit of a puzzle, and we have to sort of think it through. Gold, in my way of looking at it, has three components for people who trade it. One are what I call the Armageddonists, the people who think the world is going to end at some point, probably soon, and that the way to prevent it, or at least assure something for themselves, is to own a stable historical source of value. And there's something to this. Gold has never been not valuable. Gold has rarely lost its value for long, even when it went down to like 300. So there is real logic to that. And if you look at the world economic condition and the world financial condition, it's easy to become worried. The only way to really get rid of the amount of debt that has been amassed primarily by the industrial democracies around the world is to inflate it away. And even if there's no inflation now, it's my contention, and this gold chart's contention also, that, because what you're not seeing in this chart, of course, because it's only a year chart, is going back 5 years. If you go back before the financial crisis, this up and down that you see here is a small variation on a steeply upward sloping chart. So it's my contention that over the next 10 years, central banks will, although they won't admit it officially, will both condone and sponsor a much higher interest rate, inflation rate than we have been used to. Right now, the ECB supposedly targets 2%. The Fed unofficially targets 2%. I will guess that sometime, once economies start growing again, and they will, it's not going to last forever, that you will see much higher long-term inflation rates, because the only way that the United States can eliminate $16 trillion in debt or reduce it is by inflating it away, and that's what I think it will do. Okay, that's one response to this gold chart, not particularly this chart, but the one that goes back 5 and even 10 years. So gold, the people who are concerned about this particular item, and this of course ties in to the second category of people who are interested in gold, and that is people worried about inflation. And I just gave the answer on that one. The third one are people who are trading gold as a commodity, and they can simply look at it and say, well, if people are worried about if the euro is close to collapse, and the Fed and the ECB are flooding the world with liquidity, we've got existential threats here, and we've got inflation. Two people are going to be buying gold. Let's buy gold too, because it's going to go up. Those people are the ones who sell it first whenever there is a change, because they're more in trading profits, so they get out. Okay, so we have, despite the ECB's firewall. Remember that term from 2 years ago? Oh, we got to build a firewall. Nobody's building firewalls anymore. They didn't work very well. At any rate, gold went up anyway. Despite the ECB's break on the immediate problems of the euro, gold went up anyway. So we have to sort of think about why. It's my idea that the response of the ECB, if necessary, so if you get, would be to buy debt. Well, again, the ECB says they're going to sterilize it, but I don't think anybody really believed it. And so you really didn't have that much of an issue. In a way, the ECB's admission that this is what it has to do is an admission of the failure of European policies on the debt crisis in the long run. So if the credit markets are going to be driving Spanish, and look, if the ECB hadn't done that, then it's very likely that the credit markets would have continued with rates at 7% or even higher. So the credit markets, the private markets judgment on, and actually you can see this. This is 726 right here. The first response of the gold market was to sell off, and a decent amount, from 1625, actually not very much. For gold, that's not a very big sell-off. But the first, that's a sell-off. That's a sell-off. That, as I say to my kids, that's a sell-off. Anyway. But the initial reaction to what the ECB did was a sell-off in the oil price because of the things we've been speaking about. Give me 1 second and I'll take a look at those comments and see what we have to say. But after that, I think the realization came very quickly that the economic situation in Spain is not going to get any better. It's likely to get worse. And so all of the things that are behind the rise in Spanish interest rates haven't changed. One thing has been removed. The ECB is probably not going to collapse. The ECB, the euro is not going to collapse at the moment because they're not going to let it. They're going to give, they're going to give Greece the money. They're going to intervene in the sovereign markets that they have to. They're going to keep the ship moving, regardless how much water's coming in. They're going to keep bailing. But all of the other developments throughout this period, China's slowdown, up and going on, problems in the U.S., slowdown in the U.S., all of those things sort of quickly began to counteract, I think, the initial response from the gold price. But look at the difference in the oil price. Now, oil went up, but not much. Because oil is actually not trading quite so much on what the central banks are doing. And we're going to talk about the United States in a second because I think that's another important part of this. So the oil price went up from about 87, which is a pretty decent rise here. But because oil has so many other factors in it, you could easily put this rise on what's going on in Syria, on some of the problems back and forth across the Syrian-Turkish border. But what's clear, I think, is that there was no dramatic change in the way the markets viewed oil as to the way they viewed gold, completely differently from the way they viewed the currencies, based on what the ECB did. Okay? So that's one of the things which is good about what's called intermarket analysis, that it forces you to come to a conclusion about why a market's moving. With the currencies, I think the logic is pretty straightforward. The ECB had their effect. It's not nearly so straightforward, and what it also means is that when you get another type of shock, you won't come to the wrong conclusion about which way the currencies are going to go. I'll talk about that and the differences in the dollar in a second. Okay, what do we have here? Yeah, there's a new biography out about it now. It doesn't seem to have dealt quite adequately with some of the problems, the enormous famines and other things he caused in China. Okay, never mind. I understand what you're saying about inflation. No, they can't inflate the system now, right? Mr. Bernanke has been right in this. What I want to say was a famous British historian, Eric Hobsbawm, I think he was 96 or something, died very recently. He was a Marxist historian. And I remember when I was working in Bermuda, reading his, I think it was History of I think it was a European history, and he covered Stalin. And if I remember, all of Stalin's purges and collectivizations and all the great famines and great deaths caused, he dealt with in maybe a paragraph and a half or 2 paragraphs. And in my I would read it at night in Bermuda, and I called my wife back in New York, and I'd be ranting and raving about how can he do this? What kind of historian he is? So much so that in our house, Mr. Hobsbawm is still known as the dreaded Hobsbawm, because my wife dreaded my phone calls knowing I was just going to rant and rave. Okay, sorry about that. Mr. Bernanke has been correct that all of the liquidity he's added, the vast amounts, trillions, that he's added to the United States financial system, and by, of course, the world financial, haven't caused inflation. He's been right because without demand, there's no inflation. And that's exactly what's happened here. The inflation is really a feedback loop. Prices to wages to prices to wages. Their wages have absolutely no ability, or wage earners have almost no ability to demand wages right now. So they're not offered. However, that is where we are now. And what I'm not saying at the moment that the central banks will be unable to remove this liquidity. I think they probably can in some fashion or other. That's not what I'm saying. I'm saying that in the future, if not the near future, the medium-term future, when the world does recover, and it will, and starts to grow again, that is when I think central banks, because of the vast amounts of debt, are going to both foster and then tolerate higher inflation. Problem, of course, is inflation once it gets started, and once there is an inflationary outlook in the economy, is extremely difficult to control. But honestly, I do not see the United States, no matter how this election comes out, is going to suddenly get debt virtue. I just don't see it. You know who did it? The Germans did a good job with this. You know who else did it? The Canadians did it in the 90s. They had a huge debt problem. And over years, they controlled their spending, and now they're probably one of the best-run economies in the world. I don't see that in the United States. So I think we're looking forward to a period, a generation, if you will, half a generation of higher inflation rates, because I don't think there's any difference. I mean, you can look at the way the Fed interprets its responsibilities. The Fed knows. These are smart people. Mr. Bernanke, I think, got almost a perfect 1600 on his SATs when he took them 35, 40 years ago. These are smart people. He knows that monetary policy is not the answer for the economy. He also knows it's the only game in town. And he and the Fed interpret their responsibility that within the abilities of the central bank, it's their responsibility to do whatever they can. And that's exactly how they interpret it. He knows that $40 billion a month, and we may not get to this, but I'll talk about it briefly, $40 billion a month in MBS purchases is not going to do a thing, almost nothing for the economy. If trillions in liquidity hasn't done anything, $40 billion a month is suddenly going to kick the economy. No, it's not going to do anything. In fact, what he did, I think, was focused more on the equities and the psychology of the economy and the markets than anything else. And it may give a little help to the housing market, which if the housing market suddenly started building at a normal rate, it would be an advantage and a strong advantage to the economy. But I don't think that's happening. And I don't think he anticipates it's going to happen. However, what little good he can do, they've made it clear they will do. Okay, now, I think Ben is correct that if they chose And this is what I think is what I'm talking about here, and I don't want anyone to mistake what I'm saying. I'm not saying that at some point, the economy is going to start to grow and the demand side will increase, and if there's still a lot of money sloshing around out there, it's all going to come out and start chasing various things around, and you get a potential for inflation. Yes, I think the Fed could control that reasonably well, because as of yet, we don't have an inflationary psychology in the economy. That is not what we had in the 60s and the 70s. I remember those when I was a kid. My parents used to talk about it all the time. But there was an inflationary psychology amongst wage earners, amongst companies, amongst stores that fed upon itself. And that's what was squashed by Mr. Volcker's namesake, taken out of the economy. So I don't think it takes a long time to build that up. And I think the Fed could control that. It's not what I'm saying. What I think is going to happen over the next 15 years, over the next 20 years, is that when the economies start to grow, the central banks around the world are going to tolerate a higher base rate of inflation. And I'm not sure they're going to say it, but I think they're going to. And that's the type of thing, because it has to go on for 10 years to really make a difference in the amount of debt that's out there. That's what's dangerous, because that will slowly build in an inflationary psychology. Okay. Let me do two things quickly. The interesting response. Now, I'm not going to talk about gold so much this time. I'm going to bring up one of the currencies. Let me bring up the euro. Okay, where's the euro? Where's the euro? Here's the euro. Okay. Now, what we're looking at here, we're going to look at here, is the response of the markets to Mr. Bernanke's latest endeavor. If the Fed's creating liquidity, if they're devaluing the dollar, isn't there something wrong with these charts? 9/13 was the date. Okay? 9/13. Seems to be a problem here. 9/13. And the dollar gets stronger. 9/13. And the oil price goes down. Both of those responses, I think, are twofold. One is that they're essentially profit-taking. And two, what the Fed did, although it's been called by everyone unlimited, except for me, is far less than unlimited. It simply becomes background noise. If the Fed had announced, instead of $40 billion a month, $40 billion, doesn't the government spend that much every 20 minutes? I mean, I don't know exactly what the time is, but it's not a large amount of money in the current financial condition of the U.S. government, okay? So, or the world economy or the U.S. economy. It's just not a lot of money, okay? So the twofold. One, for this entire period here, as economic statistics were worsening, particularly in the United States, the markets were focused completely on what is the Fed going to do. Everyone anticipated, that was also helping this, by the way, anticipated some type of additional QE program. They got it. By the time the Fed got around to it, frankly, it didn't dare do anything else. Mr. Bernanke has spoken for years about the wealth effect of his programs. You'll pardon me, but that is what they would call a second level effect. I apologize, folks. As usual, I've gotten a little far afield. I hope nobody minds. I enjoy it. Okay, let me just finish that. So, the reason we had very little effect, and really this is essentially profit-taking here, was because the market had anticipated it. I think it was probably less than the market expected, and all of the effect had already been built in. $40 billion a month was basically the least I think the Fed could possibly do and not provide an enormous disappointment to the market. If the Fed had done nothing on the 13th, does anyone think we'd be trading at 13.4 in the Dow? I don't think so. I think we'd be well below 13,000 because there's nothing else propping up the Dow. The economy's not propping it up. Yeah. There really isn't anything there. So that's what's going on. The market, as the stock market has become convinced that whenever things get a little unpleasant, the Fed's going to start pouring money all over it again. The other thing is because the Fed program is unlimited, supposedly, it becomes nothing more than background noise. The only fact that will affect the markets is whether it's going to be stopped, not whether it continues. So its effect is almost immediately dissipated. If the Fed had announced $2 trillion, the dollar would still be going up. No, actually, excuse me, apologies. The dollar would be going down because it was not what the market expected. The dollar would have been going up. So again, the responses to what the Fed did are not what you'd initially expect, and they're different across currencies. Gold, as we noted, largely continued to go up. Oil has come off, and there are more than one reason for that. One, of course, is the translation effect because the dollar did not go up. So the old idea that the Fed, when it starts pouring out liquidity, automatically devalues the dollar is not true all the time. And I think the Fed realized this. These are smart people. That it is the surprise that would have provided the shock. And in this case, it didn't. There was no surprise in what the Fed did. And here in the oil, we have more than one thing going on. The oil, actually, now the euro hasn't come off very much, right? Look at this. I think it was about 131.40 or so, and it's now 28. That's certainly not a 10% move, correct? Oil is off 10%, or it was off 10% top to bottom. That's telling you that oil is ignoring what the Fed's doing, and it's trading again on supply and demand and Middle East fundamentals. So we have an interesting difference between the markets, which is what intermarket, I'm bringing it right back, intermarket analysis is all about. Okay, Vicki, I thank you very much. Let me see if there are any other questions here. Where is the EU going next? What the EU is focused on right now, more than anything else, is getting Angela Merkel reelected. So I don't think you're going to see any. They're going to do the best they can to get her through. Because I don't know what would happen, but Angela Merkel, whatever you want to say about her, has provided strong central leadership. She's not really changed her opinion, nor have the Germans, about what to do with this problem. And if you think in the long run, they are correct. Or in the short term, in the medium term, it's very, very difficult. It is very unfair, I would think, in my own opinion, for some Greeks to be marching around in downtown Athens. I mean, I know that area well. I've stayed there many times, with World War II uniforms on. That seems a bit unfair. However, there is a long and painful Greek history with the Second World War as well. I hope this was interesting, if not particularly on a linear topic line here. I thank you all for coming. We will be doing another one next week, although I have not put up the topic yet, on the 18th. Again, thank you all very much for coming. I will put up my email address, and if you have any questions or any comments or anything else, please let me know, and I will do my best to answer them. Thank you all very much, and everybody have a lovely day in all of your time zones. Take care.